On today's earnings agenda, we're going to hear from Boeing, as we said, Caterpillar, Eli Lilly, many more. Let's talk about a possible direction for the overall markets, top down. Joining us for that is Jack Caffrey, Equity Portfolio Manager at JP Morgan Private Bank, and Chris Brightman, Chief Investment Officer of Research Affiliates. Chris, I want to start with you because you've got a lot of very specific things that you think investors should do right now. The one commonality in all of it appears to be, it looks like you think there's a global slowdown. You even like long bonds, right? Long dated bonds right now. Get out of FANG, rotate into defensive areas, staples, utilities, and banks, and even internationally where valuations are cheaper. You think we're at the end of the cycle or something? You're in a bad mood. What, you hungry too? Is that it?
Well, I try not to worry too much about what I want to happen and rather pay attention to what I think is going to happen when making investment decisions. And we have had a wonderful run for the platform technology companies. As long as the environment stays the same as it has been, that trade will continue to work. But we see an awful lot of flashing warning signs. The yield curve was inverted. It's not inverted anymore, but it inverted long enough to be a tried and true recession signal. It's predicted 7 out of the 7 last recessions. And we've also got PMI that tanked. It's now down below 48 with the trade component particularly weak. These are the sort of inputs that go into our models that say that 2020 looks like a recession, better than even odds for a recession.
So we've had a decade-long bull market in growth stocks. So this is going to be now handed off to value stocks?
Yeah, and let me give you an indication of how wide that gap has been. The difference in the valuations, the prices relative to fundamentals for growth stocks versus value stocks is as wide as it was in the Nifty 50 and nearing tech bubble levels. So this is a big deal. The question is, when is the inflection point? And I think both an election and a recession in 2020 is going to cause a big rotation out of what has been performing spectacularly for the last 10 years into much cheaper opportunities. And yes, I think long bonds, look, you look backwards and long bonds look like they're extraordinarily low yield. Look around the world, though, at developed markets, and long bonds in the U.S. are a screaming buy. And that's what protects you in a downturn.
Jack is scrambling there. He's like changing everything. I mean, have you totally shifted now based on listening to Chris, or you agree, or do you want to revise everything he told us?
I think there were some points that were made by Chris that were very relevant, but I disagree. Okay. I don't think there's a recession next year.
So polite.
That was nice.
Well,
respectful.
I'm trying to be professional.
There you go.
I don't think there's a recession next year. I do think that when we now have seen the Fed shift from its tightening bias to moving to an easing bias, it will likely cut again next week and then move to an extended period of patience. And I think that is translating into almost a restart of parts of the economy. You certainly see the housing market up until yesterday's data certainly has been getting a little bit better. That has actually been feeding into some parts of the value chain. And typically, if you think you're going into a recession, it feels like buying value right into the face of that dramatic, what historically would have been a pretty dramatic earnings decline would feel a bit early. And in that regard, I think your comment about I like defensive staples utilities aligns more with the idea of a recession, but the idea of buying value
and long
early.
Bonds.
And long bonds. Again, a defensive, we think you need some duration as a bit of a hedge. I myself have liked quality. I've liked quality for the last several years. I think quality still has an ability to compound, and there's always a trade-off between relatively expensive quality and ultimately some quality that occasionally hits a bump along the way. Around earnings season has been a good buying opportunity over the past several years. And I think those are going to continue to be served up for us.
Particularly, I think what we would agree on is you combine value and quality.
Yeah.
And there are some nice ETFs out there that do that kind of a thing.
Or you could buy stocks if you actually want to do it the slightly more traditional or my way.
Yeah. I would agree, and I think that there are a lot of companies that one can find that will protect you on the downside, particularly if the political environment turns negative for the FANG stock. So you go into communication services, for example, and I think when it turns, you're going to want to be avoiding Netflix and Google and boring stocks like AT&T and Verizon will outperform?
Well, I think you hit on the idea that at some point there are communication stocks that are about growth, and there are communication stocks that are about more consistent cash flow turning strategies. And I think, ultimately, a nice way to participate and to potentially protect your ability to be in the markets winds up looking about dividends and dividend growth and taking that perspective. Show me the money today such that I can be more patient with you as you unfold.